Recent years, the number of self-made billionaires has increased, proving that everyone can become wealthy and live the life of their dreams. Imagine how much more time you could spend with your family, or how far you could go if you had more money right now. In today's video, I'll show you the 3 secret rules to become rich. Welcome to Thrive Test. If you're new here, why not hit that subscribe button and join our community. And as always guys, give this video a thumbs up for that YouTube algorithm. For years, several writers have researched the lives of thousands of money masters. And one thing they have discovered is that these people all have certain qualities in common. They understand that by following the same techniques, anyone may attain the same achievements they did. Keep an eye on the screen as we discuss the 3 golden rules that money masters follow. Rule number 1. The rule of simplicity. The rule of simplicity is the first rule that money masters practice. The rule, as the name suggests, focuses on keeping everything related to their finances simple. They know that when a topic is complicated, it is tough to follow. For example, if 2 astrophysicists are taking in scientific jargon and you don't have a background in that field, you could find it difficult to understand their discussion. However, if they use layman's terms and connect their topic to real-life situations, you might be able to understand them. While money has nothing to do with astrophysics, you must realize that if you want to become a money master, you must adhere to the rule of simplicity. So, how can you put this rule into action? To begin, you must understand your finances by keeping track of how much you make and how much you spend. That's why you must keep track of your spending to know where your money is going each month. You can do this by simply writing down everything you intend to buy for the upcoming month, or by examining your account statement if you pay all of your bills with the same credit card. It is also vital to categorize your costs so that you can have more precise financial information to experiment with. Then, you must identify what your financial goals are in order to design an effective plan for accomplishing them. For example, your financial goal could be to retire at a certain age, or to save money for a trip or retirement. Whatever your goals are, keep them simple if you want them to be attainable. The next step is to automate your finances, which means you must find a way to make your expenditures, savings, and investment function with little or no involvement from you. Stay tuned and I'll show you the actual steps to take. To do this, keep in mind that the first step is to understand your finances by understanding how much you earn and spend in a year. You might, however, plan your finances using the 50-30-20 rule. That is, you should spend half or 50% of your earnings on your most pressing needs, 30% on your wants, and the remaining 20% on savings, investments, and debt repayment. Please keep in mind that this rule is simply a guideline and that you can modify to match your own needs. The next step is to automate the payment of your expenses. I'm sure you'd agree that keeping up with organizing your entire bill payments on a monthly basis may be quite challenging. There may be times when you're undoubtedly so busy that some payments go unpaid. Fortunately, you can avoid this mistake by automating your bills. But before that, list down all your monthly costs, beginning with the ones that are fixed, such as your mortgage or rent, insurance, loans, credit card balances, utilities, subscriptions, memberships, transportation, and so on. By doing so, it becomes much easier to see which expenses can be automated and which cannot. Thanks to the modernization of technologies, most services now include a recurring payment system, which allows you to set up a payment plan once and have all your bills be automatically paid on a specified date. As for some bills, like your monthly rent, automation may not be possible, but you may talk to your landlord to see what options you could have. The best part is that many banks let you accomplish all of this from the comfort of your own home, so you'll never have to worry about which bills you need to pay and when to pay them. Now that you know how to pay your bills automatically, let's look at how you can do the same with your savings. Most individuals are terrible at saving money. But with automation, you can be certain that you'll have enough money to bank at the end of each month. The first thing you'll need to do is open a savings account on top of your checking account. You may go to your bank and set up a monthly transfer from your checking account to your savings account. Believe me, you will learn how to live on less money. Finally, let's talk about how to invest automatically so you're better prepared for retirement. You can do this by automatically contributing to your employer-sponsored retirement accounts such as the 401k or an individual retirement account for your employer-sponsored account. You can ask for more information regarding this matter to your Human Resources Department. Overall, streamlining your finances will make money management easier, reduce stress, and allow you to avoid paying bothersome late fees which you already know are a waste of money. Before we go to the next secret rule to become rich, I'd like to ask you guys if you've already automated your bills, payment, and saving. Did it make your cash management easier? Would you recommend it to your family and friends? Or would you rather stick to the conventional way of saving and budgeting? Let us know your answers in the comment section down below, since your opinions and ideas truly matter. Rule number 2. 80-20 rule. The 80-20 rule is the second rule that all money masters follow. This rule, also known as the Pareto Principle, was initially developed in 1895, and it has been shown time and time again to be incredibly effective. The Pareto Principle, sometimes known as the 80-20 rule, states that 80% of the consequences or outcomes result from just 20% of the causes or efforts made. In other words, this rule encourages you to identify the few things in your life that produce the best results with only minimum effort or resources, and to concentrate entirely on those activities. This rule can be implemented in a variety of circumstances, which I will discuss now. The goal of this rule is to assist you in determining which activities will provide the most return on your time, money, energy, and resources. For example, the outcome of focusing on low-income activities all day would be less than the outcome of focusing on high-income activities for a short amount of time. As an example, a student should strive to discover which parts of a textbook will provide the most benefit for an upcoming exam and prioritize those. In other words, study smart rather than hard. If we relate this to earning money, let's say you're engaged in the business of selling luxury items. Your market is a mixture of those in the higher and middle classes, among whom 20% are those of the higher class and 80% are from the middle class. At this point, you might think that most of your sales will be coming from the middle class, which is the majority of your customers. However, upon checking your financial statements, you found out that 80% of your sales were coming from the 20% of your customers, the higher class. This is because, even though 80% of your customers come from the middle class, they don't buy your products as often as those from the upper class, and would usually opt to buy those with lower prices. What would you do? So instead of wasting resources and energy on the 80% of your customers who doesn't contribute much to your profit, you should be focusing your marketing strategies and efforts toward the higher class. With this, you will be able to earn more profit with fewer resources. Another practical application of this rule is with your staff. Let's face it, we all know which employees are putting in their best efforts every day and which are merely there for a paycheck. Your goal is to create productive people so that they can bring in more income for your organization. Finally, this rule applies to your daily life and activities. Unfortunately, many individuals squander their time on low-value activities because they believe they are valuable. Responding to people's comments on your company's social media page, for example, may appear to be a good idea, but it is something you can outsource to someone while you focus on other critical tasks. Before you begin any activity, ask yourself how much it will contribute to your success. If the answer is that it will have little impact, you may want to reconsider. Rule number 3, the 10% rule. The third rule that all money masters follow is the 10% rule, which suggests that you must invest at least 10% of your monthly income towards your retirement. Although there is no fixed sum that you must save for retirement, financial experts have developed certain estimates that will assist you in saving enough money for retirement. One of them is that you should save at least 25 times your yearly living expenditures saved up for retirement. Some financial gurus also recommend that you save at least $1 million in your retirement account. With $1 million in your retirement account, you can live comfortably on $40,000 a year for the next 25 years, assuming you have paid off your mortgages and other bills, like a student and auto loans. I'll show you how to save $1 million for retirement by following the third essential rule that all money experts adhere to. I'll also assume you want to retire at 65 and show you how much you'd have if you started investing 10% of your monthly salary at 25, 30, 40. Finally, I'll go through some of the assets you may invest in to ensure your retirement goals will be achieved. To begin, you should be aware that the average 401k portfolio yields an annual return of 5 to 8%, depending on your market conditions. Thus, for the example in this video, I'll take 5% as the yearly average return. Starting at the age of 25, assuming a $100,000 yearly wage and a 10% monthly investment, you would have a total of $1,213,859 at retirement. If you begin investing at the age of 30 and earn $100,000 each year, you will have $907,796 in retirement. To have over $1 million in retirement, you would need to earn at least $150,000 yearly and invest 10% of your income. And if you start investing at the age of 40 and your pay is $100,000 per year, you'll have just $480,091 in retirement. You'll need to earn at least $200,000 yearly to have over $1 million in retirement if you invest 10%. On these examples, you'll notice that the earlier you start investing, the better the total return. This is because the individual who started investing the earliest gave their money more time to compound, which means that the earlier you start investing, the more interest your investment will accumulate. So if you're watching this video right now and haven't started investing for retirement, stop watching and start moving money into a retirement account. The accounts I'd recommend starting are 401ks and IRAs because they give tax benefits. A 401k account is your employer-sponsored retirement plan, whereas an IRA is an individual retirement account. Both offer some tax advantages such as investing with pre-tax income in traditional 401ks and IRAs. There's also what's known as a Roth account, which allows you to invest with money that you've already paid taxes on, and it will be tax-free in retirement. If you're wondering what you may invest in to ensure you have money when you retire, here are some of the greatest assets to consider. Bonds, mutual funds, index funds, and of course, stocks are all great assets. You might even invest in real estate by purchasing rental properties and earning passive income when you collect rent. In summary, you may become a money master by adhering to the 3 secret rules outlined in this video. All you need to do is stay focused, be disciplined, have a strategy, and carefully adhere to these rules. Thank you for watching this Thrive-tastic video. So if you found it valuable, consider subscribing to our channel and joining our awesome community. And if you're still hungry for more, we handpicked this awesome Thrive-tastic video for you to watch next. 5 mistakes stopping you from retiring.